Our next question is from the line of Dhruvesh Sanghvi. Please go ahead.
Yeah. Am I audible?
Yes, sir. Please go ahead.
Yeah. Ashish, just wanted to have your views on, how should, as an industry, we should think about the cost for the similar kind of hotels as yours in terms of new rooms. Let's say we take a broader basket of the top 7 cities where you are in. If you can give a broad understanding of what is the cost of production equivalent metric for per room basis that people cannot sell below 3,000, 4,000 or some number and some reasoning around it. And where I'm coming from is that why is India so expensive when it when it comes to this overall room rates basis, that far better properties are sometimes available in international places at a cheaper cost than ours. So, I just wanted to understand where is this coming from?
So, Dhruvesh, let me first put the comparison in correct context, right? And my apologies, a lot of our discussion will be centered around big city business hotels, right? So
Absolutely.
I would urge, participants on this call to not triangulate that to tier 2 leisure resorts, non-business hotels, right? That's a completely different model, so to say. If you look at tier 1 business hotels, right, and if you compare the size of the India market today, travel and tourism market, right, the average room rates in India continue to be at a significant discount to their global peers. I'll give you some examples. Today, I feel really excited to report the numbers that I have reported, wherein a Holiday Inn Express, and I'll take you to that actually slide, right? Just a second. If you see, for a Holiday Inn Express platform, we are pretty excited to report an average rate of 3,700 rupees, which is $45. Now, if you were to separate Holiday Inn Express in a Bangalore or a Hyderabad, that number would go to $52, right? Now, Bangalore and Hyderabad are markets which today have 100 million square feet of occupied office space. They're adding anywhere between 7 to 12 million square feet of office space every calendar year. And in a market like that, to sell a Holiday Inn Express for $45 to $50 does not make us nervous about having outpriced ourselves, right? And please don't get us wrong. We're not trying to be too ambitious comparing ourselves to Singapore or Hong Kong or Tokyo or New York. We're still comparing ourselves to office markets that are much smaller like Sydney, where a comparable hotel will be selling for $120, right? So we actually think today hotel rooms in India seems to be expensive because we were used to very cheap hotel rooms for last decade. But if you were to compare a hotel room price to an airline ticket price today within India, or if you were to compare a hotel room price to that of a comparable hotel in a similar city globally, you would actually think that there should be a lot more excitement and expectations from the industry to keep growing this average room rate. That's point number 1. Point number 2, what can spoil this party? I don't think it's demand, because demand is unquestionably very promising for broader economy and therefore for travel and tourism. We just economic indicator for how the larger economy is growing, right? What spoils the party for hotels tends to be the supply, right? And that is where we have now entered a period of very stable supply growth, largely on account of the fact that the big cities are sitting on reasonable inventory, right? So you look at Bangalore, today it has about 22,000 branded rooms, okay? We actually got somebody to collect total number of rooms in Bangalore from one of the OTAs. It's 109,000 rooms in Bangalore, right? So 109,000 all rooms, right? 22,000 branded rooms. For this city to grow at 7 to 8% on demand, it needs many more rooms that the city is capable of creating, right? So today the supply is not even 50% of the demand growth in Bangalore. No surprises, our ROCEs are looking at being in mid-20s, right? Hyderabad is following. Gurgaon is following, right? So we actually think that today the supply is in a state which is going to remain very stable which is going to remain way below where the demand is growing. And therefore, as operators, owners, asset managers, we feel fairly confident that there is good 5-6 years before we need to relook at demand and supply. In terms of cost per key, I think for each segment that would vary. For the upper upscale, if you look at the industry data, you would see that the construction cost for this is in the range of about 1.2, 1.4 crores per key. If you look at the upper mid-scale, which is Fairfields and Four Points, that same construction cost will be 60 to 80 lakhs. And if you look at the mid-scale segment, that cost would be in the range of 40 to 60 lakhs. This is construction cost, does not include land cost, right? So that's really the going-in cost for a hotel development in India. You have to overlay on top of that land cost. You have to overlay on top of that the cost for 3-4 years of a development cycle. And that's why you would feel that even at the current room rate, it is not extremely attractive that you'll have hordes of money flying in, right? Especially in tier 1. So I think we feel fairly confident about a reasonably long and a stable supply environment. Demand, as I've said, we've never had any questions on, not today, not in the last decade.
Sure. And just one more follow-up on that is that, considering the environment that you have explained, I find you to be very conservative with the kind of aggressive history that you have had. Why are you suddenly so conservative in terms of growth now when the money is flowing for you?
So, Suvesh, the past is a fact and I can't deny it, right? And the future is a promise which I typically don't make, right? So the facts can't be changed. And what is the fact? And I did talk about this, by the way, if you see. I think it's important. I think what we are saying is we are future ready. And I'll echo your sentiments here, right? First, I think we see phenomenal opportunity, right? The office market, the aviation market is growing unabated, right? 40 million square feet being added by this country in a year is another Singapore, almost another Singapore, right? So this is really exciting times for us to put hotel in. Total Singapore office supply will be 40 to 60 million square feet, right? So you're almost adding maybe 2/3 of a Singapore in a single year in India, right? Two, our past strategy of acquisition turnaround and also much less talked about strategy of variable leases has worked really well for us. The reason why we took the bold call of doing a 1,200 crores IPO, resolving our debt in one go, was to allow us the financial flexibility to grow the business, right? But Suvesh, I will talk about growth as I keep delivering it. Today I had to answer because a lot of people expect that, the whole growth was 5,400 rooms. That's absolutely, my apologies. We, I think, expressed our agenda incorrectly or inappropriately. 5,400 rooms is what we hold in the business today, of which 4,800 are operational and the balance 600 were in different stages of development. That is not our growth path. Our growth path will come from deploying the free cash we get from the business for new opportunities, both acquisition turnaround, also variable leases, which tend to be very, very financially accretive. So you're absolutely right. We are focused on growth, and 5,400 room was not our growth target or promise.
Fine. Thank you. Thanks a lot.
Thank you. Our next question is from the line of Pankaj Bobade. Please go ahead.
Hello, am I audible?
Yes, Pankaj.
Well, thanks. Thanks for taking my question. As I understand, we are more of a business hotel. Ours is a business-related hotel group. And our presence is mainly in the cities which are more of business centers, which is in line with what hospitality industry is in around the globe. But of late, we have seen in India that religious tourism is gaining currency. And the footfalls at cities like Varanasi, Ayodhya are far higher than what Goa is witnessing. So just wanted to understand, do we have any plans to capitalize on this booming market?
Pankaj, of course, nobody wants to get on the wrong side of religion ever, right? But I think there's clearly a lot of pockets of demand in India. There is core business travel, there is the traditional leisure travel, there is the new homestay-led leisure travel in India, which is a completely different segment, expanding very rapidly. And within that is a subset of religious travel, right? So there are quite a few pockets of growth in India. You know, for us, our immediate focus is on continuing growth in our core business markets, and that's largely leveraging our existing portfolio. You know, I mean, look at ACIC. The fact that this portfolio was at 32% EBITDA margin, and we are confidently confirming to you that we see that growing to high 30s, if not 40s, in a short period of time, is largely because we can leverage our existing portfolio in big cities to create economies of scale, right? So for us, our near-term target is to use our existing portfolio and use that as, I would say, a base to jump for a higher inventory in the similar market. We are continuing to evaluate how one can create a sustainable, a scalable, and a profitable business, both in leisure, including the subset of religious tourism. But I would say that we are nowhere close to creating a strategy or having a conviction to start deploying capital, right? Does not mean that we don't believe in those opportunities. We need to have our own business model, and we don't do anything which is one-off, right? Do two or three. We need to have something which is scalable, which is sustainable, and which is financially accretive to us as well, right? Two, don't forget the fact that religious travel, because it is so attractive, is also attracting a fair bit of private capital, right? Which means a lot of HNIs and individual investors are putting capital for hotel development in religious places, and that's a supply environment that we would like to watch out for before we deploy our own capital. So for a variety of reasons, we like all of this, but we are seeing clear of that in the near term to focus on our core strategy.
Thanks. And second question would be, what is the timeline, if you could give, by when we would be positive on PAT level?
Let me take you through that. So as in the last quarter, if you see, we delivered a PAT of 60 million before the one-time exceptional item. A PAT loss, a PBT loss of 6 crores before exceptional item. I did mention to you earlier that we took the call of almost writing off the entire value because we do not want any impact of that coming in the subsequent quarters, right? So with this strong performance in quarter 3, Pankaj, we think that we would report a positive PAT in the next quarter or 2 quarters, right? I mean, the next quarter seems very highly likely to be a PAT positive quarter, but it's about a quarter or 2 that we will be PAT positive on a sustainable basis. We were almost there, but for the exceptional provision that we made for a single issue.
So you mean to say we have return of 76 crores before PBT, right?
No, after PBT, before exceptional items. Let me just take. So, in the front face of the financial statement, there will be PBT before exceptional and PBT after the exceptional. So we've written it off as an exceptional item, post PBT, before this. Here. Yeah, if you see here. So we have a PBT excluding exceptional items of 6 crores loss. Then we have taken the exceptional item to report our PBT and then PAT, right? So if this 760 was not there, you can see that we had 60 of PBT loss, and then we had some tax income which was coming to us. So we would have been almost break even on a we would have been almost break even on the PAT level in quarter 3, but for the exceptional item. So quarter 4 looks like a very strong contestant for being a PAT positive quarter.
So we are almost there, right?
Yeah, we are there. I mean, and now it's more semantic and optics. Otherwise, from a financial perspective, we are there.
Okay. Thank you. Thanks a lot and good luck.
Thank you so much.
Thank you. Our next question is from the line of Dhruv Agarwal. Please go ahead.
Yeah, hi. Can you hear me?
Yes.
Yeah, good morning, sir. Sir, I have little bit more questions, so pardon me for that, sir. Sir, basically, sir, Samhi Hotels is multi-branded and is present at multiple price points, and as well as we can see that traveler leisure segment has increased multifold after COVID, which act as a growth driver for hospitality industry. So in relation to that, what kind of RevPAR and occupancy level one should expect in coming years, say for 24 to 28 at consolidated level, sir?
Okay, Dhruv. So you're asking something that is a bold forecast, right? Okay, let's look at the historical numbers. We have seen, so for the last 4 quarters, there has been a concern if we have reached the peak of the cycle, right? This pretty much started, I think, here. So if you see, we've seen minus the seasonal adjustments of different quarters, we've actually seen the RevPAR growth accelerate from 15% in the first quarter to 16% in the second quarter to almost 20% in the third quarter, right? We believe that the industry, from a demand-supply perspective, is well positioned to maintain a double-digit RevPAR growth. I would kind of not give a very specific point target, but I think a double-digit RevPAR growth is a very reasonable expectation for the industry to deliver over the next 2 to 3 years, right? The second, which is even a more important aspect, is that, as you know, the occupancy levels today are reasonably okay. And I'm just putting the slide here for our portfolio 9 months occupancy. If you see Delhi 80, Hyderabad 78, Pune 76, Chennai 72, other cities 72, Bangalore 69. What we are seeing really is that the occupancy levels across India have reached that magical 70 plus mark, right? Now, we would expect this to continue to grow, and unlike the historical myth that business hotels can't reach a 72-73% occupancy, we've actually seen business hotels do really well on occupancy levels, largely on account of the fact that we are doing very strong on weekdays, right? So the weekday occupancies, if you see, have been almost in the 80% mark for the last 9 months. We believe that with very little supply coming in the most of the metros, the occupancies should continue to remain fairly strong and have the potential to stabilize more closer to 80 than closer to 70, as was the expectation, for many years for business hotels, right? That's number 2. Rate growth will obviously be good because now hoteliers are not worried about filling up the rooms. They are quite confident about sustainable high occupancy levels. So I think you would see them improving the rates year-on-year basis. We have seen some of the corporate rates for the next year being signed upwards of 10% growth on a year-on-year basis. That gives us the confidence of a double-digit RevPAR growth. But the most important thing really, Dhruv, is operating leverage. If you're talking about a RevPAR growth of 13-14%, right, for a good quality operator, asset owner, that would mean that the EBITDA growth is in excess of that, right? And I think that would be the focus for many large, good quality asset owners in India, because you are in a long upcycle. The operating leverage will all accrue majority to the asset owners, right? So we actually think we are in a very sweet spot where even if we get a 11-12% revenue growth on same-store basis, that should give us a 14-15% EBITDA growth for the same-store assets as well, right? And for us, you would see that we are trying to make sure that we are not only dependent on the market forces, and therefore we have a lot of growth prospects within the company. I'm not talking about the new acquisitions or leases, but within our portfolio, a lot of our hotels will be repriced during the current year and towards the end of the year under a new brand, operate at a much higher average room rate. A lot of our new inventory will be ready to be completely operational, and the operating leverage from the ACIC portfolio will start to kick in. So as far as we are concerned, we have delivered really solid both revenue and EBITDA growth. We believe we can continue that for a reasonable period of time because of the fact that growth is already owned by the company for next several quarters now. So Dhruv, I'm sorry I'm not giving you exact numerical answer to this, but I am only telling you that we are fairly confident and optimistic about a double-digit RevPAR growth, continued operating leverage, which will allow the EBITDA growth to be higher than that, And for our portfolio in specific, have multiple levers over and above market forces to make sure this growth continues.
Right, sir. Sir, like one more question related to that only. Like, sir, you have said, like, is my understanding correct with regarding to EBITDA margins? Like, you are saying like 14 to 15% growth in EBITDA margins would be there like over the years. So, is my understanding correct, sir?
No, EBITDA, absolute EBITDA growth, right?
Yeah.
Yeah, absolutely. I mean, a 10% revenue growth should give you a 13-14% EBITDA growth. If you're looking at 12 to 13% RevPAR growth, then you'll actually see. Look at this year. Our same store assets, the revenue growth was 17.6%, EBITDA growth was 28%, right? So that's the operating leverage you're talking about. So EBITDA growth for next several years will continue to far exceed the revenue growth. And that is something that a lot of us need to start focusing our attention on, not just on rate occupancy or RevPAR.
Okay, fair enough. Like, sir, excluding the increase in number of rooms, are there any further growth plans of the company like to venture into something new, which will act as a driver for increase in the revenues, sir?
So, we don't need to really disturb the apple cart, but I'll give you an example, one example, and there are many more like that coming our way. Look at this particular hotel. This is currently a 301 room hotel, which has 79 apartments. This is a high frequency in Pune. We have initiated steps to increase the inventory because we have the scope for increasing inventory in this particular asset. So it can potentially go from 301 rooms to almost 330 rooms, right? That's one. We're adding more attendee spaces because we are seeing discretionary spend improving and there is a demand for dining facilities. Then we are looking at actually a reasonable renovation of the public areas, restaurants and meeting spaces. And all of this will help us improve what we call our rate share in the market. So that basically means that today, if we are achieving 90 percentile of a competitive set, we expect that to improve to over 100% of our fair share, right? So that gives you, a rate growth which is independent of where the market is headed. This is one of the assets. We are preparing and will showcase that to you in the next quarter presentation. We will bring two more large assets in focus, where we expect that we have reasonable intervention thought through, where those assets can deliver a much higher growth than the market would without those interventions, right? So I think given the fact that we have 31 hotels that we own today, these hotels are in different markets at different price points. We have huge experience of turning around hotel assets that we acquire, but people should, acknowledge the fact that after 5-6 years, the same experience can be reapplied to your existing assets as well, right? So we're doing this to High Frequency Pune. We'll bring a strategy for Sheraton Hyderabad to you next year, in the next quarter. We're doing something with 4 Points Pune also, which we'll showcase to you next quarter. So there's a fair bit we're doing to our portfolio through, which will help us reposition a reasonable part of our portfolio to a very different price category over the next 4 to 5 quarters. And all of this, unlike greenfield development, is a very quick turnaround really.
Okay, sir. Fair enough. And sir, like, what would be the percentage of repeat business across hotels, sir?
Repeat business. So what we can tell you is that the business coming from loyalty members, right? And as you know, our hotels operate with Marriott, which has a very strong Bonvoy program. We have IHG and we have Hyatt, so there's Gold Passport and there is IHG Rewards. We have seen the loyalty members constituting more than 40-50% of our total business, right? Now this number will have a huge swing between one and the other hotels, so giving an average is often misleading. But on an average, we've seen over 40-50% of our customers are loyalty members, which means you have a certain stickiness to the customer. Repeat visitation, of course, is a little less relevant, as is how much of the loyalty customers are using your hotel, what's the power of the loyalty program. And that number is pretty healthy when you are with programs like Bonvoy and IHG Rewards,
Okay, right, sir. And sir, like, one more question. Like, if suppose you have given any hotels for like contract management to say Hyatt, and in the same city, sir, Hyatt is also having his own hotel also, sir. So don't you think, like, sir, there could be a pricing war, isn't it? So, like, how are we able to deal with such circumstances? Like, is there any, like within the contract, is there anything like within certain kilometers the Hyatt will not open his own hotels, sir, like that, or like what is the basically the contract in that, sir?
So first of all, we have an area of protection. Whenever we sign a contract with a hotel company, we have an area of protection around that hotel where they can't sign another contract of similar category. So that really is the first circle of protection for us. And beyond that, really, you cannot. I think what we need to worry about is supply. And the fact is whether it's a Hyatt or a Marriott or a Taj, you need to worry about supply, not about just the brand that it carries, right? So we're not very perturbed about, for instance, we give no exclusivity, we take no exclusivity, right? And that's largely because our focus is on demand supply and creating an area of protection around the hotel. So I think group that has not really bothered us. But just as a footnote, current operators that we have, all the three operators, don't have any of their own invested assets in India. So there is no, from that perspective, there's no conflict where within the same city they have an owned asset and a managed asset. Marriott, IHG and Hyatt. Hyatt has some joint ventures in India, of course with Unison Hotels, Sarab. But other than that, these operators don't have their own invested capital in assets. They are operating purely as a service provider, as an operator. And that of course creates an additional layer of comfort for us that, their whole source of income is making sure the hotels are run well for the owners that they're running these hotels.
Thank you. Ladies and gentlemen, that was the last question of our question and answer session. I would now like to hand the conference over to Mr. Ashish Jakhanwala for closing comments.
Thanks, everyone. We quite enjoyed the questions. We have taken down some notes for future quarterly discussions. I would reiterate that even though we have shown phenomenal revenue and EBITDA growth in the last quarter, that's not yet the best. Two, we are, are well on our track to deliver both a PAT positive first quarter and also stay course on 3.5 times debt to EBITDA in the near term. And with that, I think over the next few quarters, we will start, focusing a little bit on the growth prospects, and we will start discussing them with you as well. So with that, thanks for your time, and look forward to speaking to you at the end of the fiscal year, really.
Thank you. On behalf of Samhi Hotels Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.